Welcome to the Mutual Funds Masterclass. Today, we are stripping away the complexity and exploring the world of mutual funds to see how they can actually work for you. Let's address the elephant in the room, the big fear. Movies and television have branded the stock market as a dangerous casino. Because of this, the biggest fear for new investors is simple. What if I lose all my money? Think of investing like a journey. You could take the DIY route, driving the car yourself through the stock market. That requires high effort and high expertise. Or you can take the chauffeur approach, the mutual fund. Here, you hire a professional so you can focus on the destination. You don't need to know every road to get where you're going. So, what is a mutual fund? Think of it as a financial bus. Instead of everyone driving their own separate car, many people pool their money together to ride in one large vehicle driven by a professional fund manager. This manager can steer that pool of money into equity, debt, gold, or even real estate. You'll often hear the term NAV. In a company, you have a share price. In a mutual fund, you have net asset value, or NAV. It is simply the price of one unit of a mutual fund. Usually starting at 10, the NAV increases as the fund's underlying investments grow. Not all buses go to the same place. There are different types of funds to suit your needs: equity funds for growth, debt funds for stability, hybrid funds for a mix of both, and index funds or ETFs that track the market directly. Here is a reality check. Total capital destruction in the long term is practically a myth. If you stay invested for 7 to 8 years, even the worst performing equity scheme is mathematically highly likely to outpace a standard fixed deposit. How do you get in? Direct investing demands too much of your time, and advisors can demand high fees and manual execution. Mutual funds provide the optimal middle ground. You get expert access without the constant tracking. There's also the purchasing power problem. Say you want to invest 500, but a single share of a premium company costs 25,000 or more. As an individual, you're often priced out of the best assets. This is where the power of the pool comes in. A mutual fund collects small amounts from thousands of people to build massive purchasing power. It buys those expensive shares, slices them into affordable units, and distributes them back to you. That is the beauty of fractional power. Here's the flow. Your money goes to an asset management company, or AMC. The total pool of money they collect is called the Asset Under Management, or AUM. The AMC then hires an expert fund manager to deploy that AUM strategically across the market. The first major advantage is instant diversification. If you invest less than 2,000 directly, you might only buy one or two companies. In a mutual fund, that same 2,000 fractionally buys into 50 or more companies at once, which drastically reduces your risk. The second advantage is wholesale expertise. Because thousands of investors share the cost, you get elite financial management for pennies. The AMC typically keeps just 1% to 2% of your investment to run the fund. This is called the expense ratio. Generally, the lower this ratio, the better for you. However, we must look at the dark side, because AMCs earn their fees based on the total AUM. Some care more about aggressive marketing to bring in new money than they do about actually generating great returns. Then, there's forced liquidation. When markets crash, experts want to buy cheap. But if retail investors panic and withdraw their money, the fund manager is physically forced to sell good stocks at massive losses just to generate cash for those redemptions. Finally, there is the innovation straitjacket. Managers are often constrained by rigid mandates. For example, a mid-cap fund cannot buy a great large-cap stock. To protect their jobs, many managers play it safe with well-known stocks, which can lead to underperformance. To succeed, use goal-based mapping. Never invest blindly. Assign specific funds to specific life goals. The flexibility of your goal should dictate the amount of risk you allow the fund manager to take. Take the vacation matrix as an example. You cannot take high risks with a child's education, but a luxury vacation is optional. If a high-risk fund performs well, you go abroad. If it underperforms, you vacation domestically. This is the only proper place for high-risk funds. Hope you understood everything about mutual funds. Like, share, and subscribe for more videos like this. See you in next one. Until then, happy trading.